While some online bullion dealers continue to charge $4 over spot for US Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend from TF Metals Report, Craig Hemke. Craig, it's great to have you back on the show.
Doc, it's always a pleasure. Hello, Eric.
It's been a brutal day for the metals, and Craig's comment just before we went on the air just about sums it up. He asked if he was allowed to use profanity on the show today, so that kind of sums up the sentiment here. Gold and silver had been up this morning, actually, had jumped on the COMEX Open. Silver had burst back through $20. Gold had actually popped back above $13.50, so both pretty significant technical numbers. And then, lo and behold, as soon as London closed and Europe was closed for the day, both gold and silver were smashed pretty viciously. Gold lost about $20 in only a couple minutes. Silver down, what, about 50 or 60 cents, down to about 1960 is the bottom. It's pretty clear here the cartel has gone into action, don't you think, Craig?
Yeah, it's actually been going on for 3 days. We first noticed this back on Wednesday when it seemed that there was a pretty hard ceiling put in on gold at about $13.60. We saw it again yesterday at $13.60, and today is plain as day. You know, I actually speculated to my podcast listeners back on Wednesday. It was so unusual. And if you watch the trading patterns, it was so clear that there was an event taking place by one of the bullion banks to try to maneuver price down from $13.60. We actually speculated Wednesday afternoon. That could be any one of a number of things. I mean, it could have been maybe a bank with a position, an over-the-counter derivative position that they needed to keep under $13.60. Maybe somebody was on the hook for delivering some metal. Any one of a number of things. But it was clear on Wednesday that $13.60 was being defended. Anybody can go back and look at the chart and see it. And we could see what made that so clear was the divergence between what has been driving price and driving the specs on a daily basis, which are these HFT inputs of interest rates and changes to the dollar yen. Gold price diverged from that, and that was all one of the signs that we knew that it was a bank operation Wednesday. We saw it again yesterday, when price just got mercilessly beaten down, especially after the COMEX closed. And today was just the most egregious of all. The four economic data points that came out were all horrific. Gold moved forward from the lows that it was beaten down to late yesterday, from 13.43 all the way up to 13.61. Again, above that, for some reason, critical 13.60 level. Everything looked fine. Those key drivers of the dollar yen had collapsed all the way back down to 101. Interest rates had moved all the way from 228 down to 222 on the long bond. And gold was up at 13.61. Well, as you said, we got Europe closed. And even though interest rates had managed to move up, you know, a paltry 1 or 2 basis points, and the dollar yen didn't move at all of a sudden gold was absolutely smashed, silver as well. And there just couldn't be a more clear indication of cartel/bullion bank involvement to, for whatever reason, desperately reset price today. Yeah, if you're going to find a bright side, it's that the miners, at least as we record this, haven't bought it or haven't played along. They're about unchanged on the day and still comfortably up on the week. So I think the only logical response is to understand that this is just a continuation of the paper derivative pricing scheme that the bullion banks run. Let them do their thing like we talk about. I mean, the old Mississippi leg hound joke, if they lay into you, you just got to let them do their thing and finish, because there's nothing you can do about it. And we'll just see where we go from here. The logical response is to not look a gift horse in the mouth, accept the bargain, and buy yourself a little more physical metal, knowing that this simply can't go on forever, and it won't.
In fact, if this happened after the London PM fix close, and as late as in the day compared to the timing of the releases of these economic reports, is significant because it suggests that the motivated sellers were also interested in not creating more physical strain on the London market, because it does serve more for physical offtake compared to the lunacy of the COMEX. So that the miners being bought, all of those little hints, those little data points suggest that this is just their machinations and what they're doing, and longer-term money is still interested in buying these dips, and they're doing it right now in the miners, and we'll see how long it takes.
Nothing has changed. Nothing has changed fundamentally. And these bastard banks are backed into a corner because they've played along as long as they possibly can by just continuing to flood the market with new shorts. And we see it in the COT report. We see it in the bank participation report. And these jerks, they sit there and they just keep flooding in paper, trying to meet spec demand, and then on days like today, just overwhelm the bid with brand new paper contracts that they short to try to smash price back down. They're losing. And as long as global interest rates continue to trend negative and more negative, they are going to continue to lose, because there has never been on God's green earth a more strongly positive fundamental reason for owning physical gold and silver than negative interest rates. We're seeing it now. An article on Bloomberg today about a German bank is now the first in Germany to actually institute negative rates at the retail level. I mean, that's people like you and me, guys, going into your bank and the bank saying, well, if you're going to keep this cash here, you're going to have to start paying us to hold it for you. Well, the logical response is, well, screw that. Give me my cash, which is all part of why not only is the ECB, but also the Fed looking in the Treasury Department looking to eliminate cash so that you can't do that, so that you have no option but to sit in the bank and pay them. They recognize, that this is here to stay. And the old saw against owning gold was that, besides the fact you can't eat it, is that it doesn't pay a dividend. The opportunity cost, because it just sits there and collects dust. Well, collecting dust beats the pants off a negative 1%. And when your principal's rising at the same time, and you don't have currency risk like you do in a German or a Swiss or a French bond, this is all pretty cool stuff. So, you know what? Let the MFers do whatever they need to do on a daily basis. I find it extraordinarily painful to watch and frustrating, and it's the kind of thing that is probably shortening my potential lifespan every time I see it. But I know how this ends. In the end, these banks are going to lose simply because there's not enough physical metal to prop up their paper derivative scheme. That NERP, that negative interest rate, is the most positive fundamental ever created. It'll drive more and more people into owning gold and taking it away from these banks, and eventually they're going to have to get out of the game. So, we see these days like today, but you just have to take them with a deep breath, recognize what's going on, and then, again, take the only logical next step, which is to accept the sale price and add a little bit more.
A little bit further to just that fundamental reason of NERP, Craig. Explain to those who may not really be familiar with what that's going to do to capital and driving that out of the banking system.
Well, it's like anything else. The banking, it's just amazing that we've actually gone down this road. One, it crushes the banks for two reasons. One, excuse me, from a traditional banking model, banks have made money going back to the time of Moses, for God's sake, by borrowing short and lending long and capturing the spread. Well, when you're trying to lend long at negative interest rates, it just doesn't work. And the stress that is applying to large banks and small banks across the Eurozone is significant. That's a big part of what the problem is with Credit Suisse and Deutsche Bank and all the Italian banks. So just from a structural standpoint, negative interest rates are just killing the banks. But they also, I guess we just call it the fundamental rationale of withdrawing cash from the bank. Folks need to, if they haven't yet, pull up Mike Maloney's site and watch some of the videos he's made about how money is created, where it comes from, and understand that all fiat currency is essentially debt. And that banks at the retail level are the ones that create the cash. Ask your neighbor. If you don't already know this, and I'm talking to anybody listening to us, go watch one of his videos and learn how it works. Ask your neighbor who thinks he knows everything. Hey, how's money created? And he'll probably give you some, the Treasury Department creates money. Money's created when you deposit cash in a bank, and then the bank loans out as much as they can versus their reserve ratio requirements. Okay? So when you withdraw cash from the bank, which is the logical response to negative interest rates, you are deleveraging the system. The central banks are essentially shooting themselves in the foot by pursuing this policy. But they do it anyway because they don't have anything else that they can do. They're out of arrows. They're out of bullets. I'm sorry, Eric. Go ahead.
Traditionally, and traditionally, about 85% of money or so-called money, our fiat credit, 85% of it that's in the system, digital and so forth, is actually created by banks. It's not the Federal Reserve that's doing it. It's
exactly
the banking system.
Exactly. If you put $1,000 in your bank, they're going to create $900 new dollars. $9,000 new dollars and loan it out, right? I'm doing the math right. Anyway, that's how it works. Or I guess they create $900 new dollars and loan it out, and then that 900 goes out and it gets deposited someplace, and then that bank creates $810 new dollars and loans it out. That's how it works. That's where the new money comes from, and nobody understands that. And so, we've got a monetary base of however many trillions and trillions of dollars in the U.S., but there's only $1.3 trillion in actual currency. This war that they have, this idea that gets floated by Larry Summers and all these other goons, is to eliminate the $100 bill. And they tell you, we got to eliminate the $100 bill because nobody uses it. And in fact, the only people that do use $100 bills are criminals and bookies and drug dealers. Well, if you eliminate the $100 bill, you eliminate more than half of the hard currency in the U.S. Now, why would they do that? Because if you've got $10,000 in the bank, and now your bank's going to charge you -1% interest, and you go, well, screw that. I'm not paying $1,000 a year for them just to hold my cash. And you march yourself into the bank and ask for your $10,000. First, you got to jump through 1,000 hoops, get looked at every which way to Sunday as if you're some kind of criminal, right? And they got to clear it, and they probably might not even have $10,000 in the bank to do it. But if they're going to do that, they're going to give you then what? 100 $100 bills. Okay, that's a lot of $100 bills if you've never seen $10,000 in cash, but you can wad those up, fold them over, stick them in your pocket. But if they eliminate the $100 bill, they're going to give you 520s. Well, who the hell wants 520s? And you're going to say, screw it. Okay, fine, keep the cash. And that's what they're trying to do. That's why they're trying to eliminate the $100 bill. That's why there's a war on cash, so that individuals won't have the choice. They'll have to keep money in the system so it can't be delevered. Again, all of this logically augurs to the physical ownership of gold and silver, true money. And that, again, is the bankers shooting themselves in the foot. Because as more individuals demand physical ownership of metal, they don't want to deal with unallocated and pooled accounts, like you get from some of these rummy mints and places like that around the world. They don't want to deal with COMEX contracts. They don't want to deal with, no, give me the real thing. And every ounce that you withdraw out of the system, the banker system forces them to delever and eventually takes their power away, power to do what they did today. God, can you tell I'm pissed off? I'm really bummed. I got to tell you, I'm really in a sour mood. This today was the most egregious, blatant, disgusting bit of grotesque bank price manipulation I've ever seen. But yet all the goons and bubbleheads on CNBC, yep, goes down. I don't wonder why. I'm sorry. Now I'm getting all worked up. I apologize. I'll stop. Take a breath.
We're not going to edit this out either.
Take a breath, Craig.
Tell us how you really feel.
Yeah, sorry.
Here's at least some good news that we can look and point to. We should have normally seen a lot of jawboning this week. I mean, the Fed and all of their monkeys love coming out and trumpeting when they're launching their propaganda about strong economy, recovery, blah blah blah. And with with Bureau of Labor Statistics report last week, you would have expected to see them come out this week and start doing that. And in fact, it made that as a formal forecast, and I'm happily wrong because it suggests that part of what's going on is that they don't want to pressure financial markets and risk upsetting the goose that lays the golden egg of psychology and keeping all of these plates spinning in the air moving into the election.
Yeah.
So maybe that's what's going on here. They tried to do this one-off with the statistical machinations of the BLS report. But even earlier in the week, the expectations for a December rate hike were declining in probability. I mean, the market participants seem to not be buying this BS.
Yeah.
Every once in a while this week we've seen a little percolating interest in the precious metals, and what do they have to do? They have to wait until the London PM fix is closed today to beat the crap out of the sector and try one more time to keep us away from 20 handle silver at 1360 gold.
Yeah.
And it's all desperation.
I think a lot of folks don't understand. I mean, the banks, they talk about TA and they say, oh, TA is worthless in a manipulated market. Well, fine. If you want to think that, Mr. Smarty Pants sitting in your underwear, knock yourself out. But what you need to understand is the banks paint the charts because the speculators, the big traders, the hedge funds, they do believe in that nonsense. And then you got the shills out there, Avi Gilbert and those types that count their little waves, and say, oh, look at gold failed on major wave 3 of subcount B. Well, gold failed on major wave 3 of subcount B because the banks made it fail, you dumbass. Didn't do it on its own.
Well, if you take Elliott waivers as technical analyst, you can probably put 100 in a room and get 150 different forecasts.
Well, and it's all done. It's all done for a reason, man. You see that smash today just to get it priced back down to 1340, and so now everybody will sit there today. All the little seeking alpha dorks will write their stuff this weekend. Oh, gold failed and gold rolled over. Well, it only rolled over because some bank waited in at precisely noon Eastern, 5 p.m. London, and smashed it with 20,000 contracts in 10 minutes. I mean, this is not complicated, but yet these dorks play along as if it's some kind of free and fair market. It's not. It's not. And so the banks paint the charts. The dork analysts write about it as if it's legitimate. And then the funds, sit there and play along, and it becomes somewhat self-fulfilling. So when you see a level defended, as it was this week at 1360, something's going on. I mean, it was blatant to watch from Wednesday, Thursday, and today what was being done at 1360. Again, we don't know. Maybe some banks in there and they're trying to defend some position or some big over-the-counter derivative bet that was expiring today at 1350 or something. You don't know. It's all opaque and nobody knows how those markets operate and what the actual bets are. But all I know is you just look at the chart and, man, price manipulation is like pornography, man. It's hard to define, but when you see it, you know what the hell it is. And today was egregious and grotesque. And it's, like I said, I'm sorry. You guys caught me on a bad day. I think I'm just going to go get drunk. You think I'm kidding?
We should put a contest out. How many beers did Turd knock down today?
Yeah, I need to go knock back a couple shots. But I still got to do a podcast for everybody on my side, so I got to keep my act together and somehow remain coherent for another couple hours. What else would you like to talk about, Doc?
So what's been the reaction today, Doc, as far as SD bullion sales and people buying the dip?
Yeah, I've been somewhat surprised here with the big move down. I mean, we've definitely seen an uptick in order flow, but it's definitely not crazy. I mean, it's basically, I just call that an uptick in order flow. It's nothing like a mad rush into physical, just a steady flow of orders. And really, what's interesting is really haven't seen much big money in the market here the last couple of days. It's the average investor who's buying probably his weekly or monthly average in purchase of anywhere from 20 to 50 ounces up to maybe a monster box is the majority of purchases we've been seeing here the last few days. So it's been interesting, especially with the price action where we've been at. And just personally, I've been impressed with the markets over the past week, how they've responded, with gold and silver almost being pulled like a magnet back up over $20 and $13.50. And I really wouldn't be surprised at all to see the same thing happen early next week, probably by Tuesday, to see gold and silver pulled back up through those levels. We'll see. Obviously, the cartel banks, especially with open interest in silver, would like nothing better to get the ball rolling down the hill, as it were, especially in gold, to prevent new 2016 highs, which really would get the metal moving towards 1,400, and once there, probably back to 1,500 by the end of the year.
You know, and Doc, if I might, while you're talking about silver, I just want to get this off my mind too. There's two things people need to be aware of as we head into next week and in the latter parts of August. One, copper is smashed as well today, back under its 200-day moving average for the first time in about a month. That is a negative for paper silver, in that just think of it as either when copper has been above its 200-day, it's been kind of like a wind in silver sails. But when copper is under its 200-day, it's like a headwind. And now it's back under the 200-day. And so that is kind of a headwind for paper silver trading by these HFT machines. The second thing that everyone's got to be aware of is September is a front month, a delivery month on the silver COMEX, which means all of the volume for the last couple of months has been primarily in the silver month contract. That will be shifting to December as gold is now in December as well. But we got to go through that transition over the next couple of weeks, meaning that we will have September options expiration in about 2 weeks. And then we'll have the silver contract go off the board and go into delivery in 2 weeks as well. So all of the remaining open interest in September silver will have to be liquidated. You know, everything but the paltry 3,000 contracts that will stand for delivery, and then JP Morgan's house account will take delivery of all 3,000 of them. Or they'll be rolled. And just a lot of that selling pressure will sit on silver as well. So we could always catch a surprise. You never know, on a daily basis what might happen. But those are two kind of headwinds for silver, at least probably now through the end of the month.
And that's probably why they're defending 20 so aggressively.
Yeah. I mean, I haven't looked at the current open interest of the $20 calls. There's probably more than a handful. Yep. And so I've been telling folks at my side, you can see this happen in July in gold as well as we move toward the expiration and the delivery of the August contract. It's the same thing that happened in May as we move toward April. It's the same thing happened in May as we move toward June, and March as we move toward April. We happen in July and into August. And I told everybody to expect a rebound back toward the 2016 highs here in August. We got all the way to 1372 or 3 last week, and should have been there this week too. But whatever. I would imagine now September again will probably be who knows how that'll go. I wouldn't expect brand new charging to new 2016 highs until maybe late September, October into November. And by then I think we'll be looking at something toward 1,480 or 1,500 in gold, something 24 to maybe as even much as 26 in silver. And then probably sideways into the end of the year, locking in those gains, and then we'll see what kind of magic 2017 brings. But again, the main thing is, at least for the next 2 weeks, those are going to be a couple things that are going to be working against silver getting into momentum to the upside, besides the incessant garbage that we saw, today.
Yeah, and I'll toss this out as well, too, because I know you'll thoroughly agree. All magnations and just the difficulty of getting over 1850, the difficulty of getting over 20, staying over 20, the difficulty of getting over 22 that we will see in the later portion of this year, and on, 25, 26. We will be seeing a stair-step kind of aggravation like what we see and experience today. It's not, and people need to be aware of this. It's not going to be a straight line, and the reason why it's important to keep this in the back of your mind for people who are new to this market in particular, it's going to not be a straight line, and don't get scared by all of the various people that'll come out every single time we get to one of these critical levels, and then the manipulation gets a step up, and the kind of stuff that we see today is something that we slogged through for over a month.
Yeah.
The 20 handle here.
Dude, think about this. Think about this. On COMEX copper, the amount of total open interest of paper contracts, paper ounces of copper, versus the amount of copper that is mined annually is about 15%. In COMEX gold, the amount of total paper ounces of gold on the COMEX versus total mine supply is about 60%. In COMEX silver, it's 120 freaking percent. And nobody's, and the CFTC could do what? That's no problem. Can you imagine if like ADM and I don't know who the hell else, Monsanto and ConAgra and all these companies got together and we're short 120% of the global soybean supply? I mean, do you think that might set off a few alarm bells? You know, do you think that'd just be okay? Oh, it's just a market that we can count our little silly waves and get some new idiots to buy our newsletter. Give me a break, man. If anything tells you why there's this gold-silver ratio that's at 70 to 1, at least everybody's scratching their furry little chins going, I don't know how this could happen. How could it be 70 to 1? Well, it's because the price determined on the COMEX is a joke. It's a scam. Oh, but that's okay. 120% of mine supply shorted by the banks. Give me a break. But that's the world we live in. God, I tell you, I am worked up today. I'm sorry, Doc. Jeez Louise.
You kind of lost in all this, or forgotten about, is the news this week that the LME is going to add a new paper market.
Yeah. I saw you posted earlier the conversation I do every week with Eric Sprott, and he was just beside himself and I asked him, I said, do you mind if I ask you about this? Because I don't want to, put you on the spot regarding the World Gold Council. And he goes, oh, God, please ask me about the World Gold Council. Well, I'm on the record with those people. I mean, if anything, my God, if anything tells you whose side of the bed they're sleeping on, the World Gold Council, what a scam of an organization that is. They rape people by collecting fees out of the fraudulent GLD. That's how they get their funding in the first place. And now the World Gold Council is happily collaborating with the LME and Goldman Sachs to come up with a new physical contract that relies entirely on unallocated metal. If you read the specs of the contract, it says for physical delivery of this contract, customer must deposit unallocated gold with one of our 5 banks, Goldman. And then if you take physical delivery, you get unallocated gold in return held at one of our banks, Goldman. Sign me up. Where do I get some of that? That sounds like a great deal.
Now, for listeners who might be either new to the gold and silver market or, for whatever reason, completely unfamiliar with the terms, Craig, I'll give you first shot. If you want to break down, what exactly does that mean, unallocated gold?
Unallocated is not gold that you own. You're in a pool of other people. It's like unallocated is like, in a sense, it's almost like a bank. Think of the scene in It's a Wonderful Life, where there's sirens in the streets and there's a bank run and all those old folks show up on George Bailey's wedding day demanding their cash out of the Bailey Building and Loan. And he's like, I don't got any cash, man. Your money's in Bob's house and Bob's money's in Joe's house, and
so what are the banks when gold is unallocated? It's in unallocated vaults. What is Goldman Sachs doing with that gold?
They're using it themselves as collateral, and there might be for 10 ounces of unallocated claims, they might keep 1 ounce around, or let's use a bigger number. Let's say for 1,000 ounces, they might keep 100 in storage, so that if some joker shows up and says, I'd like my gold now, I'd like it, George Bailey. Oh, okay. Well, here's 50 ounces. See, we got it right here. But if everybody shows up at once, like they did to George Bailey, they don't got 1,000 ounces to give to everybody. And so they're playing a confidence scheme, confident that you'll remain confident in their con game because that at some point, if you ever show up, they'll give it to you. But if everybody shows up at once, it ain't there. It's not there.
And I want to give I'd like to give a real world example from a customer we worked with just in the past week at SD Bullion. I mean, this is a 7-figure customer who has multi-million dollars in gold and silver stored at one of the most widely recognized depositories in the U.S. in unallocated bullion. And he was working with us. He decided he wanted to get it stored offshore. This was an IRA. So we have a program we've launched recently where customers can store metal segregated and allocated in the Cayman Islands. So it's pretty close. It's a lot better than Hong Kong because you don't have to pay like $3 an ounce for silver to ship it the other side of the world. But so this guy was paying a flat $200 account fee per year for all his gold. And so then wants to know, well, why am I going to be charged a couple of basis points, I can't remember, 0.3, 0.25, something like that, for gold storage for segregated allocated gold? Like I was only paying $200 a year flat fee for my unallocated account. Well, you don't need to be charged too much when they're not storing gold for you.
That's right.
There's no insurance. There's no, I mean, if you're actually storing $10 million worth of gold, you got to insure that. The depository has to insure that. The depository has to actually store that. It costs money to store your metal. It costs money to insure your metal. It costs money to move it around. But if all I do is type a couple digits in the computer, Charlie's got 10 million of gold sitting in his account.
Yep.
It doesn't cost anything to insure that. It doesn't cost anything to store that.
That's right. And again, what we're waiting for is this kind of eventual build up or run on physical metal. Because for the first time, it's not going to happen at the COMEX. Every time I read something about, COMEX is going to default, I just roll my eyes. Eventually, one of these pooled accounts, one of these unallocated accounts, that's where the failure is going to come from. And the confidence scheme is going to begin to unravel and crash because someone's going to show up. It's kind of like, and we've talked about this before, the just-in-time food delivery to your grocery store. You know, you don't go make a run on all your stuff, milk and bread and all that stuff, because on any given day, because you figure you can always go tomorrow. But whenever there's like a blizzard or a hurricane coming, you always see the empty shelves because everybody goes at once because they think it's not coming tomorrow, right? That's the same principle here with these unallocated accounts. Everybody, yeah, I'm not too worried about it. Yeah, I'm charging fee on imaginary gold, but whatever. If I ever need it, I can get it. Well, and all of a sudden, people figure out that that's not the case. That's when the fireworks start. I'm sitting here, guys. I now see it's 2:40 Eastern, and gold's making fresh lows on the day at 1340. Anybody that follows my site knows we track every day how the HFTs buy and sell gold based off movements in the dollar yen and in the bond market. Since noon Eastern time when this began, the dollar yen has moved from 101.16 to a current right now 101.18. The long bond has moved from 222.5 to 223.5. Gold should, on any regular day, still be about 1356 or 1357. So I got 1341. That's $15 that the banks deliberately have manipulated and driven back out of gold. And anybody that wants to sit there, any smart ass that's going to type in a comment on your thread and say, oh, these guys always claim it's only manipulation to the downside. Because that's right. Because it is always manipulation to the downside. Oh, you might occasionally, some bank may see an opportunity to gun the stops and squeeze a handful of little shorts, particularly right around contract or option expiration. But it is always manipulation to the downside. Why? Because it's the banks who are always short, for God's sake. If the banks are ever long, you might get some manipulation to the upside. Give me a break. This is price manipulation in its purest form on the criminal COMEX. And you saw it live. You're seeing it right now as we speak.
So what's your guys' gut feeling right now? Is this going to continue into the Globex Open Sunday night, or is this going to be a one and done while London's closed here? And by the time London opens on Monday morning London time, late Sunday night, or I guess early Monday morning Eastern, are we going to be back up into the 1340s, maybe 1350, and closer to 1990 or $20 silver?
We've seen it for over a week, Doc. 1340 has just been a solid floor for gold. It's been bounced back from there now every day of the last 6. Silver has used 1950, or the area maybe between 1950 and 1960 as a floor for almost 2 months. Silver has been in a range, a $1 range between 1950 and 2050, going back to July the 3rd. So until and unless you get breakdowns really between below 1320 in gold and below 1950 in silver, it's just all shenanigans. It's all just BS. So those would be the levels to watch.
And the funny thing is, after 2 months of that, I mean, if gold and silver do break out to new highs later this fall and into late fall, this 2-month period in silver is really going to be healthy for silver after how far silver was extended through the month of June into early July.
Yeah, we've worked off a lot of overboughtedness, if you want to call it that. You know, 'cause silver has moved, what, 30% this year?
It made a big move, but it's really been consolidating for about 7 weeks now.
Yeah. If it's something that long-term doesn't bode well for the banks, they don't give a damn, just like the central bankers don't give a darn about their negative interest rates. They're just worried about getting through the day. And so if I'm right, if there's some massive over-the-counter derivative bet, that's off of all exchanges that JP Morgan or Goldman Sachs or Deutsche Bank or somebody has, that was to get gold below a certain price by the close today, well, maybe that'll be not the case someday in the future, but they got it done for today, and that's all they care about. Now they can head out to their strip joint, the traders can, and go to the strip joint and crack open the champagne and make it rain with some dollar bills, and all that stuff like they do.
Well, your point about the September contract expiration for the silver contract is really important, and odds are the cartel's probably going to try to keep that under wraps just so that they don't get blown away. Yeah. And we have seen, 2 weeks ago, looking at where the market was, and the pressure coming in from the cartel capping and whatnot. 1920 held last time, and maybe we'll see 1920 serve as the point where the bottom fishers wanting in are going to be strong enough to overpower the cartel selling, and that'll mark the bottom. Who knows? We'll see. But 1850 is a really strong sport, and the bottom line is that every single time the cartel has been able to execute these kind of raids, we've seen either one of two things: reversals that lead to tight range trading, or spikes higher with our great Loch Ness pattern that we talk about and joke about periodically. Yeah. And then they're able to get the kind of capping going and then a range trade after momentum has been sopped up. But they get no ability to really take the wind out of the sails of this bull market in any material form. So that's probably what we're going to see. I mean, last week, after the unemployment report, the carnage that came in the market was actually repaired reasonably quickly, all things considered, earlier this week, and it was only the aggressive actions later in the week that brought us once again under 20. So they're pressing their case, and that's probably what we're going to continue to have to struggle through in the next week or two as they try to paint the tape in advance of the contract expiration for the silver contract in September.
And I just added one last thing for everybody. If folks out there that haven't watched it yet, you do go to YouTube and type in Grant Williams Nobody Cares. And it's a presentation that Grant Williams, who's just a great, brilliant guy, presented at the Mines and Metals Conference back in December of last year. And it was at that time, nobody cares. And what he's talking about was nobody cares about gold and silver. None of this matters. Nobody cares. The key stat that he had in that presentation was that during the third quarter of last year, the total exposure of global pension funds to gold and gold-related investments was 0.15%. So now here we are 8 months later. Gold's up 25%, silver's up 30%, the Hui's up 170%. And you can only imagine, what is the total exposure of global pension funds now? 0.3%? Maybe? And so, you know, we're
it's probably all managed by Kyle Bass.
Yeah. Well, and I am very angry today, and I just can't get away from it. 5 years ago, I'd be just apoplectic, just banging my head into my desk, thinking that this was never going to end. Negative interest rates and that stat, and watching that video from Grant Williams should tell everybody that this is going to end. And so the bastards can do what they think they have to do and screw as many people in the process because they don't care. But they are the ones who are going to get it in the end. I'm talking Vlad the Impaler type stuff. And we're all going to live to see it, and I cannot wait for it to happen.
It's already unfolding. The reason why we're at 19 plus in silver and 13 handle gold is because the cartel had to back off earlier this year because a very, very small percentage of managed money from the conventional world started to care. And that's why we see close to 500 metric tons added to the GLD, and the rise in the open interest in the silver kamikaze longs going up against J.P. Morgan. I mean, these people, though they are trading paper, they're interested in this stuff because of the negative interest rate scenario, because of all of the fundamentals for gold. People are starting to care, and even though even in the paper allies that we have are doing battle in the paper markets, that's where the price discovery is, and that's where the cartel has had to deal with the threats that come with, you know, that small incremental increase in people asking for their allocated gold causing problems in the cartel, or the shenanigans that we saw today where they only bombed the market after the London PM fix. I mean, that's pretty fishy. We can't say definitively that they're doing that because they're worried about physical strain in the London market, but that's what it smells like. We are winning. We're in the end game, and it's just painful to see this kind of craziness that happens on Friday. But in the grander scheme of things, it's a sign of weakness on the part of the cartel.
Yeah, and I'd add to that, you know, I make fun of poor old Whipsaw Clive, but I mean, he's stuck in 2015. I mean, I was nervous. Anybody can search my site and read the stuff I was typing about from Valentine's Day on in February, because the way the spec positions had expanded and the banks were shorting, everything told you that they were going to, the banks were going to come and lay the wood to everybody again in a typical wash, rinse cycle of the specs. But they haven't been able to do it. Why? Because negative interest rates have changed everything. Everything.
The psychology is radically different amongst the Western. 95% of money is under management in the conventional world. And when you add on top of that, the fact that the vault supplies have been largely depleted given the manipulation that we've seen since 2011, and particularly since 2013 April, when we had that 400 metric ton drive-by shooting dumped into the market on a Sunday evening. And even Dennis Gartman had to admit that that was outright manipulation. I mean, people are waking up and they're seeing what's going on. And the situation for the cartel's ability to manage prices is greatly reduced compared to where they were just only a couple of years ago. So we are going to go higher as more and more people begin to care. And Grant Williams will have a smile on his face at some point.
And like I said,
maybe even you.
The only logical reaction to anybody listening to us is to understand that this is all BS. It's all garbage, what you see in these markets and on these charts and the banks and the way they're trying to screw everybody. The only logical thing to do, Doc, I bet you'll sell everybody some silver at a pretty good deal if they go to SD Bullion, and that's what everybody should do this weekend. Get it while you can, because when the time comes that this all fails, when it all fails, it's going to be too late. You're going to be like, the old men at the Bailey Building and Loan. You're not going to be able to get your hands on it. It's going to be too late.
All right. Well, before we close the show, Craig, if you can let everybody know where they can find your regular work.
They can find me posting from Detention Center 17E in Minot, North Dakota, which is where they'll be sending me, I'm certain, within the next 6 months or so. But a lot of us will be there. And so I think we'll all have fun together as we eat potato peel soup and freeze. But until then, I'm still running tfmetalsreport.com and just waiting for the black sedans to show up outside my house.
But they'll let you wear your yellow hat with the straitjacket. Don't worry.
I hope so. I don't know. That would probably mean some kind of special concession. I don't know about you guys, but seriously, I mean, I look at that little camera on my MacBook every day, and about once a day I glare into it and give it the finger because I figure somebody's watching. They're watching right now. Yeah, I can see you back there. Anyway, tfmetalsreport.com. We got a pretty good handle on this stuff. People use the site to time their physical purchases and save themselves some coin along the way as we all prepare for what is most certainly coming.
All right, Craig Hemke, always great to have you back on the show.
Doc, it's a pleasure. Hopefully next time I'll be in a little better mood.
All right, for the Doc, Eric Dubin, and Craig Hemke, thanks for tuning into this week's SD Weekly Metals and Markets.